Welcome back. You're still tuned into ET Now, and as promised, let's put the spotlight on Cantabil Retail. This counter has reported steady set of numbers for the fourth quarter. Revenues have seen an uptick of nearly 15% on a year-on-year basis, and margins have come in at about 31% versus 26.5% that the company reported same time last year. So it was a steady set but for the fourth quarter. But what is the outlook for FY27? To understand that, we are now joined by the CFO of Cantabil Retail, Shivendra Nigam. Mr. Nigam, afternoon. Thank you so much for joining us here on ET Now. Ashesha this side. First up, if you can take us through what led to this kind of revenue growth and margin expansion in the fourth quarter, and whether this is sustainable as we head into FY27.
So, a very good afternoon. Yes, we are continuously delivering these numbers on a sustainable basis, if you see. So the margin expansion happened slightly on a gross margin side, because we already mentioned whenever we have a better gross margin, that will directly replicate in our PAT margins, EBITDA margin in fact. So we have been very strong, robust gross margin, which has come up to 60%. And as far as sustainability number, all the numbers, whatever we have been delivered, we have been promised that have been delivered. So we are looking these numbers on a long-term basis, these gross margins, EBITDA margin, PAT margin, which looks long-term sustainable.
Okay, so the numbers are sustainable. That's the word coming in. But Mr. Nigam, Vision 2027 of the company highlights about 1,000 crore of revenue in FY27. And to be able to achieve that, you need 17% YOY growth in FY27. Are you confident of being able to achieve that target?
Absolutely. If you see for last 5 years, our CAGR growth is approximately 22%. Last year also we delivered by the end of this financial year, as we published yesterday, is 18%. So very much on target. We are definitely crossing 1,000 crore revenue mark by maintaining these EBITDA margins and other margins as well. We are absolutely on target.
All right. So looks like 1,000 is an achievable target, and you could achieve more. Is that so? And what could that figure be? Would you like to increase your guidance in that case?
We are working on this so that 20 plus percentage of growth, we are looking at it. Market is slightly tough for last couple of months, you can say, but we are still delivering our numbers. April was also good. So 18 plus percentage of growth is obviously achievable, maybe on a higher side, but we are promising to grow approximately 20% year-on-year basis.
Okay, so 20% growth on a year-on-year basis is what you're penciling in. But Mr. Nigam, also wanted your sense when it comes to SSSD growth, which came in at about 5% in the fourth quarter. When we look at the trend on a sequential basis, we have seen some bit of slowdown. Is consumer demand and consumer trend and sentiment at large a concern for the company?
We have seen post GST rationalization on 22nd of September, the demand uptick was very high. October numbers were great. November numbers were very nice. But post that, there is some demand slows down, but we have achieved our target. And from last couple of months, we have seen uptick as well. So from very long time, we are promising on a long-term sustainable number 5, 6, approximately 6, 7% of the same store sales growth, driven by volume as well as value as well. On a longer basis, we are also looking to maintain this. It may go better, but at least 5 to 6% we are continuously achieving. And going forward, this number should go better. So to achieve our overall target of 20+%.
Mr. Nigam, since you're hinting at demand slowdown, could that actually turn out to be a concern going forward, not just for you, but for the entire industry, especially at a time when the sentiment clearly is not very positive because of West Asia crisis and elevated inflation levels that we are now penciling in? Could demand actually turn out to be a problem for you?
It's not a problem. I would not say it's a problem. As you mentioned, it's a concern. But this concern, the moment it will be settled down, it will come up, no doubt about it, because the consumer is still there in the market. Obviously, when it comes to the discretionary buying, they may suspend their buying. Simply, they're not stopping it. Probably there will be suspending. So from April onwards, we have seen an uptick in the demand. March was also there. December, January, and February itself is slightly on a slower ride. But on a longer basis, we are very confident that these numbers not only will come up and the demand will pick up, no doubt about it.
Okay, so demand will pick up, and you believe that demand is only a concern and perhaps not a problem at this point in time.
Absolutely.
You added about 53 stores in the year gone by, and you're looking to reach about 725 stores by the end of FY27. Is your target on track?
Absolutely on track. Actually, we have added 91 stores last year. But since we are having 650 stores plus now, so every year approximately 10% of the stores are coming for the renovation post 9 years when they released it. So we are getting the better opportunity. So as far as the very less closures performance for the companies, actually we opened 91 stores since renewal has been done. So once it will look as a shutdown of the store and the new opening. So net numbers is 53. However, we worked on 91 stores for the last financial year. Going forward also, the 725 stores by FY27, 1,000 crore, absolutely on that.
And Mr. Nigam, what will the capex requirement be for this new store additions and how will those be funded?
So we are for last 5-6 years, you can say we are absolutely debt-free company, and we invested in the business in 6-7 years, a very good amount of approximately 300-400 crore. That is all from the internal accrual. We are a completely debt-free company, and going forward also, whatever the capex requirement is being there, absolutely from the internal accrual. As far as capex is concerned, for last year also, our average store size is 1,700. On this basis, our cost is that capex is approximately 1,800 rupees per square feet. On this, you can say approximately 30-35 lakh rupees per store required. So overall requirement for store expansion, including my inventory, is approximately 50 to 60 CR annual basis, and that will all be funded from the internal accrual. In fact, it's a cash balance, heavy cash balance in the books.
Okay, so you're expecting all the funding to come in from internal accruals and no debt will be taken for store expansion. Mr. Nigam, what is the contribution that you're getting from online stores at this point in time? Because I believe you're looking to increase that contribution as well. What will the growth drivers be for online sales to inch higher?
So as of now, my last year, approximately 6% of my contribution of total revenue from the online. Actually, this was more, but many leading players, that is Myntra and Flipkart, which is contributing approximately 70%, 60-65% of my total sales, they have changed in last year the billing pattern. So in fact, we have a growth of in volume approximately 12.5%. So this year also, when we are crossing 1,000 crore, we are expecting approximately 8 to 9% from the e-commerce contribution. And going forward in a longer basis, long-term basis, we are expecting approximately 15 to 20% from the online contribution on a long-term basis. This year, by FY27, we are expecting approximately 8% contribution from online.
Okay, 8% contribution from online by FY27 and 15 to 20% over the longer term. That's the target. Mr. Nigam, thank you so much for taking your time out and joining us, and all the very best for your vision FY27 and for the coming quarters as well.
Thank you so much for having me.
That's the management of Cantabil Retail, clearly very bullish on the outlook going forward. But that's all the time we have on this edition of the show. Thanks so much for tuning in. The management of ILGL will join us after a very short break.